Hey friends, Dan Passarelli here. How are you doing today? Super great to see you. Although I can't really see you, but you can see me. At least I think so. I hope you can see me and hear me. So if you don't mind, let's start out by letting me know that you can at least hear me. That's the important thing. Hit that questions box and type, "Hey, fan, how are you?" All right, just type something nice like fan. All right, there we go. All right. Anybody else hear me? Just fan. That's it. No. Who else hears me? I'm sure you can, but I just like to make sure. Every once in a while, there's one of those situations where you're talking and all of a sudden you're 10 minutes into it and somebody says there's no sound. And then you're like, oh, geez, Louise, just wasted my breath. All right. Thank you, Afalabi. Hope I said that right. Julia. Hope I said that right. Uh, Manish. E. Chris. All right. Thank you. Thank you. Thank you. Well, today we are going to be talking about creating success with debit spreads. Before we get started, I need to point out that options are not for everyone. Please read characteristics. Oops. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at the OCC. Don't trade with money you're not prepared to lose. And everything we're doing here today is providing generalized information, not specific to your situation. So, you're in charge of your destiny. And that's my job to help you be prepared to be in charge of your destiny, which sounds pretty good, doesn't it? All right. Allow me to introduce myself for those of you who don't know me. I don't think that's too many folks here, but I do see some new faces, and I'm glad to see new faces here. Welcome to the Market Taker / Firstrade family. My name is Dan Passarelli, and I am an author of two of the most popular options trading books, including and especially my book, Trading Option Greeks, which has been called one of the top 5 options books of all time, which is quite a humbling honor. And my other book, The Market Taker's Edge, and I write for Substack, tons and tons and tons of posts on Substack. And I record a weekly podcast that I know many of you listen to. You have messaged me and told me that. It's called Wealth Building with Options, if you enjoy listening to financial podcasts. I'm also a trader and an investor for that matter. Been doing that for many, many years. I traded on the floor of the Chicago Board of Trade. I traded on that same trading floor, but once it was owned by the Chicago Mercantile Exchange. I traded for many years on the floor of the Chicago Board Options Exchange. Traded at a company which managed a lot of hedge funds. Very briefly, I trade now in a retail trading account just like you. And I am the founder and president and CEO of Market Taker Mentoring, which is the global leader in option trader education. We have student traders in over 50 countries, which I've actually been saying for a decade. It's probably more by now. I don't know how many countries there are that, have option traders in them, but I know it's at least over 50 because I counted them at one point. Um, and I am a trading industry collaborator. I work with all the top options brokerage firms like Firstrade, for example. And I've worked with many, if not all of the options exchanges globally in some capacity or another. Um, maybe not all. There is one in Nigeria that I have not worked with, I don't think, now that I think about it. Yeah, I don't think I ever did anything with them. But outside of that, I don't know, probably all the other ones. And I'm also a family man. Those of you who are market taker student traders already, who subscribe to some of our services or have contacted us for one-on-one coaching, you probably know my wife, Kathleen, who runs operations here with Market Taker. She takes good care of you if you are a one-on-one coaching student or one of our other students. And I have my two adult children who live nearby. They live with each other. Isn't that kind of nice? And my two cute little dogs. I don't know where they are. Usually one of them's sleeping behind me right now, but she's not here right now. I don't know where she is. I just got back from a WALK. I still have to say that quietly because the one actually knows how to spell that. You believe that? Seriously. You spell it, and she's like, looks up, ears go up. Anyway, I do other things for fun besides trading and besides studying the market, which I do for many, many hours a day, every day, just because I'm a big nerd. And let's see, I'm a runner, which sometimes becomes being a walker and sometimes becomes being a biker, which is what I did today. I went for a nice long bike ride. And I'm a foodie, which is why I need to go for nice long bike rides or run. And traveler, been kind of all over the world with my family, vacationing, or with John, our head coach here, in my work with Market Taker Mentoring. And I come from a music background, musical family. We play music, listen to music. That's kind of a thing that we like to do. Now, let's talk about the important person here. Let's talk about you. That is why I am here to help you reach your goals. Think about your goals. What are your goals as a trader or as an investor? Seriously, reflect upon that. And please, at some point, make your way on over to markettaker.com and go to the top right-hand corner and click on Join Free. And you get lots of free classes. It's especially great if you're new to option trading because, oh man, there's everything you really need to get started. And, if you're highly experienced, you're already trading, but you know you can do better, go there anyway and inquire about one-on-one coaching. You can just scroll down to the footer of the website, and there's actually an application. And yeah, we do have an application process because it's not for everybody, but we'll get you on the phone with one of our members of our trader success team, probably MJ. He's our new man in charge. And MJ will talk to you about one-on-one coaching, and together you can see if it's a good fit for you. And if it is, we can help you move forward. And if not, that's okay too. We can suggest other ways to get started. All right. Now let's get into the meat of things here today, folks. Let's talk about debit spreads. Well, there's two types of debit spreads. There's bull call spreads and bear put spreads. What's bull mean when it comes to the market? It means going up, right? What's a call spread? So when you buy a call and sell another call, two different strike prices. Bull call spread, if you can direct your attention to bullet point 1 here, a bull call spread involves buying a call option and selling a higher strike call with the same expiration date. Okay? The maximum gain on this spread is the difference in the strike prices minus the cost of the trade. The most the option trader can lose is what he or she pays for the spread. And we like to choose expiration dates anywhere from a day to about 2 months. Like, holy moly, that's a wide range, right? But the expiration day is one of the most important criteria of the trade, and it's an underrated one. Novice traders pay way too little attention to selecting the optimal expiration. We'll talk about that. Now, excuse me, friends. At expiration, the maximum profit potential occurs if the stock is at or above the short strike. The short strike is the higher one. Maximum loss potential occurs if the stock is at or below the long strike. That's the lower one. So see, bull, you want it to go up. Yeah. The B/E, that's the break even, is calculated by adding the cost of the trade to the long strike price. If only there was a way to visualize this. Well, how about this? So this is the low strike. Like, let's say we're looking at, I don't know. Well, let's just say we're looking at a $98 stock. So it stock's like right here where I'm moving my arrow. I might buy the 100 strike call and sell the 105 strike call. And I might pay, let's just say $3. Okay. I pay $3. So if I hold this all the way until expiration, and if the stock is below the short strike, what happens to both of those options? They expire, yeah? And so I lose the $3, hit my maximum loss. Now let's go to the other extreme. What if the stock is above 105? I was right. It did have a bullish move. Well, then I could exercise my 100 strike calls and buy the stock at 100. I would get assigned on my 105 strike calls and sell the stock at 105. So pay 100, sell 105. Hey, I made $5. Yes, but I paid $3 for that $5, so I made a net profit of $2. Okay, net profit of $2. All right. My break even, let's say I'm somewhere between. I'm above the low strike, but below the high strike. Well, if I am above the low strike and I hold it all the way through expiration, which, by the way, I'm not going to do, but let's just say, then what would happen is I would exercise my 100 strike calls. Oh my gosh. Must be tired from that long bike ride. Oh my goodness. Exercise my 100 strike calls. So I buy the stock at 100. But I still paid $3 for the spread. So it's like I'm buying the stock at 103. So really the stock has to be at 103 at expiration. Makes sense. It's pretty easy, right? But I want to talk about this one thing here. This is an at expiration P&L diagram. What if it's not at expiration? What if it's before expiration? Well, this is where you get to see my rather incredible artistic skills. They're pretty good. I'm not going to lie. They're pretty good. All right. So if it's before expiration, you actually get a graph that looks something like this. Wow. I'm like a Michelangelo over here, aren't I? That's pretty good, huh? No, I'm more like a drunk, blindfolded Picasso, I think, huh? So, yeah. Before expiration, there's time value, there's time premium involved. And so if I get up to that high strike, in this case $105, like, and there's, like today, and there's still 3 weeks until expiration, I'm not going to hit that maximum profit unless it goes like way above it. Once I get up to this point, I'm closest to the short strike price, and I've actually got to wait it out. And ironically, a lot of people don't realize this, but you actually make your money based on theta at this point. If we have time, we'll talk more about that. That's a little nuance that I think it serves people pretty well to know that. Okay, let's talk about a bit. Wait a minute. We got to get rid of that. Think. Okay. Let's talk about a bear put spread. A bear put spread involves buying a put and selling a lower strike put. Both have the same expiration. So buy a put, sell a lower strike put. When I buy a put, I need it to go down. When I sell a put, I need it to not go down below that strike. Bear, yeah? So the maximum gain on this spread is the difference in the strike prices minus the cost of the trade. The most the option trader can lose is the cost of the spread. And expiration is from about 1 day to 2 months. Oh, so I just want to bring your attention back to this for a second. So that's why I say, because, if the stock gets up to my high strike tomorrow and there's still 3 weeks until expiration, I make just a small fraction of my maximum profit. So if I would have chosen like a shorter term expiration that coincides with when I expect the move to get there, I would do a lot better. So debit spreads like this are kind of like, you ever play baseball or coach kids in baseball? Well, I had a little stint as a little league coach for a bit when my son played when he was younger. And the thing about, one of the things about coaching little kids with baseball is they don't really care about baseball. They care about picking the flowers in the field. They care about the pizza party afterwards. They care about the camaraderie and just goofing around. But they still learn some skills that they'll need a couple years later when they actually do care about baseball. But when you're teaching a kid to catch a ball, or when you're trying to catch a ball, like, there's just a few components. If you were to build a robot and tell them what to do, there's a few components. You've got to open the mitt, and when the ball hits here, you close it, right? But as they say, timing is everything, but it's not just timing. It's also distance. So if like when the ball's hit, the robot just like goes up, no, that's not going to work. Or if like when the ball, gets down to the mitt level, it closes, but he's not in the right place, that doesn't work either. He's got to go to where the ball is going to be at the time the ball is going to be there. So this is your left fielder, right fielder, whatever, center fielder. He's got to be at the right place. The stock is the ball. The stock's got to be at the right place at the right time. So selecting your expiration date is very, very important. That's why I say from about a day to 2 months. Okay, so bear put spread at expiration. Hold on. Bear put spread at expiration. The maximum profit potential occurs if the stock is at or below the short strike. Maximum loss potential occurs if the stock is at or above the long strike. And the break even is calculated by subtracting the cost of the trade from the long strike. So it's basically the same idea. Let's say the stock is at 151 right here. You think it's going down, so you buy the 150 puts, which basically makes money if the stock goes down. And you sell the 145 puts, which basically you want the stock to stay above. So that being said, sorry, I lost my train of thought there. So that being said, if the stock is below the high strike that you bought, if the stock is below the high strike that you bought at expiration, you exercise the long strike, 150, and you sell the stock at effectively 150. But, maybe you paid $2.75 for it. So you're actually selling short the stock at 150 minus 275 is 147 and a quarter. But if it gets down below the low strike of 145, then you get a sign on that strike and you buy the stock and you minimize you maximize your gain there. Okay. You get it. You get it. So the way to think about debit spreads of either sense, or at least call debit spreads, is a call debit spread is sort of like a covered call. When's the last time we did a covered call class here with Firstrade? Oh, it's been a bit. Well, geez, we might have to do another one of those because covered calls, those suckers are important to me. So yeah, covered calls. Looks like, let's see here. Oh, we got 2 more presentations on the calendar. Firstrade's going to be asking me for some topics. By the way, if you have a topic, you can throw it as a suggestion here in questions, but I should probably do a covered call one. Okay, so anyway, it's sort of like a covered call. The long call is kind of like a proxy for the stock, more suited for the trading part of your portfolio, though. It's not a stock. It has what we call optionality. which means it has theta, it has time value, has an expiration date, has all these things that a stock doesn't have in addition to it. And debit spreads can be a good part of your overall trading strategy. Now, I'm a big fan of, if you're an aspiring option trader, is it good to know everything there is to know about options? Of course, right? The more you learn, the more you earn. The more you understand about anything, the better you're going to be at it. But here's the deal. My gosh, I lost my train of thought again. Oh my gosh, I got thrown off my game here. I'm sorry about that. Uh, but here's the deal. You don't necessarily need to know everything there, like as much as it's good to know everything there is to know, you don't need to trade everything there is to trade. So debit spreads can be one of your strategies, but you don't also have to trade everything else too. I would say, let me tell you something. If you master debit spreads, credit spreads, and time spreads, you basically got option trading mastered. It can help you trade anything else. So this is really an important one. It's one of those bread and butter strategies. Just like covered calls and all that other stuff. Okay, so let's look at a more realistic example. So this is from a little bit ago here now. And let's say we're looking at Apple and we say, well, Apple's sitting here at around 230.98. And there's not really resistance here. There's resistance a little bit higher. Got some momentum. There's a pullback, but it's on low volume. Kind of have a little bit of support actually here. So we want to cautiously play a bullish move. Okay. So here's the deal. We could buy the 230 calls, which, where was the stock again? 231 basically, and sell the 235 calls. And this would be 10 days to expiration. So here's a way that I like to think about things. Oh gosh, there's like a whole bunch of stuff to talk about here. Here's one of the ways that I like to think about things. Presumably, you watch stocks a lot, right? Now, I know there's some folks here who are just getting started on this, and you look at stocks and you're like, geez, man, I don't know. There's all these numbers. I don't even know where to start. I got no context. And there's some people who've been doing this for 10 years, and you're here just to pick up some more things and get better, because I like to share details. Even if I'm talking about a basic strategy, I like to share details to help the more experienced people. And, you look at stocks all the time and, you have a feel for what a typical daily move could be. Does a stock typically move 20% in a day, or is it more like 0.01% in a day? Depends on the stock, depends on a lot of things. And then there's people who have day jobs and they can't look at it during the day. Here's one of the things you'd need to know. You need to look at this from a percentage basis, because stocks move in percentages. Now, as option traders, that can kind of get lost. As investors, I think it's very common to think in those terms. But as option traders, not option investors, but option traders, the idea of percentages can get lost a little bit because you're now looking at percentages. You're looking at option premiums. So we need to say, look, in 10 days, how much can this, how much can the stock go up? I mean, how much can the stock go up? The stock can go up 100%, 200, 1,000%. Not very likely that Apple's going to go up 1,000% in 10 days. How much can it? Anything can happen. But how much is likely? So 6%, something like 5-6% in 10 days. That's a pretty realistic kind of no-brainer move. Like Apple can move 5% in 10 days for sure. It happens in 10-day periods all the time. So this is not like some outlandish call. It's a very normal thing. And how do we get that? We say, well, okay, 235 minus 230 is $5 divided by the stock price is like 5 or 6%, right? Okay, so now we've got a context. So 235, actually it's closer to 4 or 5% now that I think about it because the stock's at 231, right? So the high strike on a bull call spread sets your target. And you think about your target as what percentage move am I forecasting for in what period of time? Oh, now stuff is kind of coming together. Yeah? Right? Doesn't that make sense? It's always such a mystery. How do I set my short strikes? I don't know. Does it really matter? If I'm buying a bull call spread, doesn't matter what the strikes are, right? If it goes up, it goes up. Well, not necessarily. So we talked about how to set your expiration date and how to set your strike, but those two must go together. Forecasting that Apple's going to be up 5% today, well, that's a pretty darn big move. Forecasting that Apple's going to be up 5% a year from now, well, that's basically saying I don't think it's going to move at all. 5% over 10 days. Oh, okay. Well, yeah, that's reasonable forecast. And sometimes sometimes it's going to be bigger. You think it'll go up more for some reason, bouncing, maybe it hit an all-time low, got sort of undervalued, is bouncing off support. The RSI crossed down below the 30 line and back above it. You're looking for follow through. Hey, I think it's going to go to 237 and a half or 240, which is still not really a crazy thing, right? 240. Let's see. 240 minus 231 is 9 divided by 231. Oh, I need my calculator. I used to be great with arithmetic. I mean, it's like not even 4%. That's pretty reasonable. So 4%? That's not right. 240 minus 231 is 9 divided by 231. Oh, I guess it is 4%. Well, whatever. Not unreasonable at all. So, okay. We know how to set our short strike in conjunction with our expiration date. How do we set the long strike? Oh, now there's something right there, isn't it? Okay. Well, setting the long strike also has its series of rules. It also has a series of sort of criteria that must be followed. And you've got great flexibility with it. So if I'm buying the 230 calls and the stock is at 231, what do you think the delta of those 10-day 230 calls are? Who can tell me? Somebody throw a guess in Q&A here. There are no wrong answers. Actually, there are wrong answers. But don't be afraid to give a wrong answer. Nobody? Come on. Don't be shy. Traders are not shy. Traders are bold. Fortune favors the bold. Alexandre says, you say Alexander or Alexandre? Alejandre, maybe? Sorry. I like to try and pronounce people's names correctly, but, sometimes you don't have the context. But Alejandro says 50%. Oh, Alexander. Is that pretty good pronunciation? Wow, Alexander. Okay, very cool. Cool, man. So Alexander says 50%. And that's a pretty good answer right there. Thanks, Alexander. It's at the money. It's technically $1 in the money, so technically a smidge above 50%. But yeah, 50%. Okay. Now I know that if I'm selling the 235 calls that have 10 days to expiration, they probably have a delta of like maybe 30 or something. We could go and look it up, but it's not necessary right now. Okay. So this is basically like a 20 delta spread. In the short term, like today, every dollar the stock goes up, I make about 20 cents, which is not really a lot, right? I mean, my maximum profit. Okay. Hey, let's see who's smart here right now. Here's a good, this question has an answer. What is the maximum profit? Manish, good. But you're forgetting about the premium. And it kind of depends on what we pay for it, right? But if we pay 505 minus 260, let's see, 5.05 minus 2.6 equals 245. Yeah, or 240. Well, yeah, you probably could get it for 240. Let's just say 245 to make it easy, because that's what I think John put in on the next slide. So it can be worth $5, but if we paid 245, that means our maximum profit would be 255. Okay, good. So if our maximum profit is 255 and it can go up $4, and it's got a 20 delta, that's only 80 cents. How do we make the rest of our money? Through time decay. So it's got to go up over a 10-day period. Don't you kind of wish that the delta was bigger on this? And maybe you do, maybe you don't. If the delta, we can make the delta bigger, but what's the potential problem with that? Well, the stock goes down. If we risk more, well, we have to risk more for the delta to be higher, right? The long option controls the delta. So what if I instead bought the 225 calls? So those are in the money a bit. Those might have like a 70 delta. If these have a 30 delta, then now my delta is 40. And I make twice as much as the stock goes up. But I risk more. And I lose twice as much as the stock goes down. Which there will be times that you want that. And there will be times when you don't want that. Another thing with the Greeks is, if I'm buying the at the money, I'm paying theta, which is pretty common when it comes to debit spreads. But if I go further in the money, my theta is going to be smaller, and I might not pay theta at all. So what did we learn here? The short options strike price is used in conjunction with the expiration date to set the target, the time and place of where we think the stock will be. The long option really controls the Greeks of the whole spread, controls the delta, controls the theta, controls the vega, controls your overall risk. See, this is why even the experienced folks attend these classes. When I'm talking about something that's pretty straightforward, like debit spreads, there's some nuances that a lot of people didn't think about. And if you did, that's great. But if I know from doing this a million times, this is a novel way to think about it for a lot of people. Okay, so the cost and the risk. If I just pay the offer and sell the bid, which I could probably do better, I pay $245, which is the most I can lose if the stock is below $230 at expiration. If the stock is above $235, I can make $255. Right? $5 strike with minus $245 paid. The break even is $232.45. So it really just has to rise. I mean, if it was at $231, it's just got to rise not even as much as we paid. It's only got to rise $1.45 because it's already got $1 head start. These calls are already $1 in the money. Okay. Let's look at another example. This here, friends, is Microsoft. This is just a hypothetical example, of course, not a recommendation by any stretch of the imagination, and prices are not current on any of this. I want to be clear about this because I'm showing you how to set these up so that I'm empowering you and not just telling you to go trade something, because I'm not doing that. Okay, so in this example, the stock kind of gapped up. Was this earnings? Maybe, yeah, it was probably earnings, right? And then kind of pulled back and got down to support, but maybe busted just a little through support. Okay. So with the stock at 516, it will be buying, in this case, this one, we're going just a little bit, $1 out of the money. Because remember, we're buying a put. So it's at 516, we're buying at 515. So the put is out of the money by $1. And selling the 510 calls, or puts rather. So paying $245, selling at paying $645, selling at $435. So we're paying $2.10, presuming we're buying the offer and selling the bid, which I could probably do a nickel better, honestly, but that's all right. Maybe even a dime better. But this is pretty reasonable, just looking for a small move over 10 days, small move lower. Nothing major. So how would we be setting this up? What is our target strike? Where do we want the stock? Where do we think the stock will be by when? Who can tell me that? Let's see if anybody learned something here today. Where do we think the stock will be by when? Alexander? Manish? Bing, ding, 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 ding. Below 510. Okay. Okay, these are my guys today here. Manish and Alexandre. Below 510 or at 510, at or below 510. I mean, we don't think it's going to like 450, you know. So at or a little below 510 in 10 days at expiration. Why are we saying that? Because the short strike is the target strike. This is the short strike because, we're circling the bid and it's a debit put spread, right? So bear put spread. So buying this one, selling this one. Yeah, we think it's going to be at 510 in 10 days. Okay, good. And so this is a pretty tight spread for $500 stock. I mean, it's like 1% wide, right? So this is a low risk trade, risking 210 to make how much? 5 minus 210 is 290. Okay. So our delta on this puppy, because the strikes are pretty close together, our delta is going to be pretty small here. We're just looking for a little 1% move over the next 10 days. That's it. If we thought the stock was going to fall more, we'd move it lower to 507 and a half, 505, maybe 500. 500 is not even a crazy thing in 10 days, 3% in 10 days for a single stock. I mean, that's not a lot. Um, if I thought that move was going to happen faster, if I thought it was going to happen, over the next 3 days, I'd do it a week earlier. Because if it does happen in 3 days, I leave some money on the table. Okay. If I wanted a bigger delta, I would buy a higher put strike. If I wanted a lower theta, I would buy a higher put strike. The higher the put, the bigger the delta on the long put, the bigger the delta on the spread. The higher the put, or the more in the money the put rather than out of the money, the lower the theta, the less negative my theta is going to be on the spread. Okay. So we're risking 210 if the stock is at 515 or higher. We can make 290 if the stock is at 510 or lower. And my break even is just simply 515 minus 210 is 512.90. Boom. Okay, what else? What did I not cover? What can I go over that you might have a question about here, friends? Anything? Because I'm going to pull up. Is there a stock today that you might want to look at? I'm logging into my Firstrade account here on the side, which got to use the two-factor identification. Firstrade likes to keep you safe, or at least your account safe. Oh, I took the wrong number in. There we go. Okay. So let's get a look at this is live. These are should you automatically get exercised when in the money on expiration or close the spread? Great question. Let's talk about that. So first and foremost, I'm showing you these examples that look like this at expiration so that you understand what the maximum risk is and the maximum loss is. But this is option trading, not option investing. So what we're trading here is the options. Buy the options, sell it for more, or sell the option and buy it back for less. We always want to close debit spreads before expiration. I'm very glad you asked this question, Manish. We always want to close debit spreads before expiration. That means a couple of things. First of all, it means if you have a profit, you take the profit. And if you have a loss, you take the loss. Every single debit spread trade you make is not going to be a winner. I hate to break the news to you, but it's true. One thing everybody here knows about me is I always tell it like it is. Some trades are going to make money. Some trades are not going to make money. Debit spreads, if it's working right, hopefully you have more winners than losers. Okay. So that's one thing you know. The next thing you know is that you're never going to hit your max profit. And you should never hit your max loss. So when you're managing debit spreads, here's what I like to do. You should sell it for 40 to 60% of the max profit. You should cut your loss at 25 to 40% of your max loss. Next thing to know for management. We don't use stop loss orders on debit spreads. What did Passarelli just say? We don't use stop losses. Is he crazy? That's how I was taught to manage risk. We got to use stop losses, Dan. We got to. No, you don't. The reason we don't use stop losses when it comes to debit spreads is because there are two options. And when you use a stop loss order, what is likely to happen is that when you go to sell it, you're going to sell the one on the bid and buy the other one on the offer. You're going to get it at the worst price and not middle of the market. When it comes to spreads, it's important to try and middle the markets. Now, when I say middle the markets, you probably think that that means trade right in the middle of the bid and ask. But no, that's not what I mean. Let's look at this Apple trade. So I was saying we could buy this at 505 and sell this at 260, paying 245. But realistically, do you think they would let us buy these at 505 and sell these at 261? Yeah, they probably would. Now, you probably can't trade these in nickels, but I think if we paid the offer on, there's a chance we could even sell these at 262. Maybe not, but probably at 261. What about this Microsoft one? Do you think that they would let us buy these at 640 if we sell these at 435? Sure, the market makers still get their edge on the trade. And that's pretty important. Every nickel of option premium is $5. If you're actually buying this spread for $2.10, that's $210. Are you going to trade one of those? Are you going to buy one of those spreads and invest $210? If you have a smaller account or you're newer at this, that answer is yes. If you have a larger account and you have some experience, that answer is no. So here's my second question. Do you think that this is the only trade you're ever going to make in your life? Probably for everybody, that answer is no. So if you're making lots of these trades, and especially if you're trading more than one contract, saving $5 getting in the trade and saving $5 getting out of the trade, $10 times a 10 lot. You know, if you're slinging 10 lots, investing $2,000 a trade, there's $100. Even if it's a 2 lot, it's $20. Do that on your next trade. Now it's $40. Do that on your next trade. Now it's $60. This stuff adds up, man. This is a game of pennies in a lot of ways. So it's important to middle markets when we trade spreads. But are we going to trade right in the middle? Are they going to let us buy this one at like, well, you probably only can trade these in nickels. Will they let us buy these at 630 and sell these at 440? No way. The market makers who are generating these bids and offers, they have to make money. Not because they're greedy, but it's because their job. It's their job. You know, at your job, you have to make money too, even if you're not in sales or, you know, something like that. The reason you have a job is because it provides value for the company. It helps them make money, right? Same with market makers. They have to make money. They're not there. It's not a charity. They're not there to do you favors. So the market makers always have to buy below the middle and sell above the middle. And there's no way around that. And that's fine. That's fair. So when I say middle of the market, I'm not really saying trade in the exact middle. I'm saying buy a little above the middle and or sell a little below the middle. Okay. So getting into the trade, that's fine. You just put it in order and hopefully it gets filled. Exiting, if you use a stop, you're going to get the worst price and you're not going to middle it. You do that once, okay, got a lousy fill, fine. You make a habit of that, you're not going to be trading long. It's going to eat away way too much of your profits. Manny says, is volume at a particular strike relevant in deciding the strike? Oh boy, that's a loaded question. Yes and no. I mean, like, if like we're talking about Apple or Microsoft here, and all the strikes around it have 350, 279, 1,002, but this one strike that you're looking to sell only has 2 contracts, that does not matter at all. It's sort of like the average volume of all the strikes around it, both calls and puts. But if you're looking at like sallyswidgets.com, some company you never heard of, and there's no volume on the options at all, well, then it kind of matters. And you really won't even have to look at the options. You just have to look at the bid-ask spreads. Because the bid-ask spread, if there's no volume at all, the bid-ask spreads are going to be miles wide. So hopefully that answers your question. Okay, guys. Oh my gosh, we covered a ton today. Good class, great questions during and at the end, great participation. And hey, friends, next week we have selling option premium, what they didn't tell you. So even if you have some experience in options, I'm going to tell you some stuff that is going to help you a bunch that you probably didn't even know. Until then, I'll see you next time. This is Dan Passarelli, Trade Smart.